Hey everybody, it's Pete Lang here, the Designer CPA, and today I want to talk about one of my favorite things for retirement, and that's called the Roth IRA. So hopefully it's something that you've heard of before, but if you haven't, that's okay too. It is basically one of the last remaining things out there that you can accumulate tax-free growth. And what I mean by that is you can contribute a certain amount every year as you work and get closer to retirement, and all the contributions and all of the growth piece are not taxable as long as you follow a couple of different things that are very minor that we're going to go over, but all of that is not taxable at any time. So you think about, like, if you start young and do it through your whole career, you're going to have quite a bit of growth, and we're going to go over that. All of that is tax-free. Okay, so before we go into the details, we have to start with who came up with this idea, and we have to give props to Delaware Senator William Roth, who came up with the idea, had it passed, and the Roth started in 1997. So it's a relatively new feature. And so back then, when in the start, you could contribute up to $2,000. Now, you can contribute up to $6,000 a year, or $7,000 if you're over the age of 50. Okay, so just like everything else, not everyone is going to be able to contribute to the Roth IRA based on certain income limitations. And stick with me though, because if this is something that you've ever heard of where you're like, I think my income limits are too high, I'm going to tell you how you can still do it. There's other ways to get around doing this and still be able to contribute to a Roth and have that Roth feature grow in your retirement portfolio. All right, so first what I want to do is go over the contribution limitations based on what you can make for the year 2021. So this is from the IRS, and what they do is they give you an idea of how much you can contribute based on your filing status. So if you're married filing joint and your adjusted gross income, which is something that you can find on your tax return, is less than $198,000, you can contribute the full $6,000 if you're under 50, $7,000 if you're over. If it's between $198 and $208, it's going to be limited, and you want to make sure that you are kind of keeping track of that. If you're going to fall within that range, it's important to know. And then if you make over $208,000, you can't contribute to a Roth IRA. If you are married filing separately and your AGI is less than $10,000, it's a reduced amount. If it's more than $10,000, zero. So you want to make sure you talk to your CPA about what your unique situation is if you fall in the married filing separate bracket. And then if you're single or head of household, you are looking at a range of less than $125,000 full amount. 125 to 140, you're looking at a reduced amount, and then anything over 140,000 and anything over 140,000, you will not be able to contribute to a Roth IRA. And of course, one of the only other things I want to tell you is you do have to have what's called earned income. So all of these income thresholds would be based on earned income, which would be like W-2s you received or the net profit you have if you own your own business and you file a Schedule C. You got to figure out what your profit is after your expenses, but it needs to be at least the amount that you contribute. So if you want to do the full $6,000, you have to make at least $6,000. All right, so if you're interested in this, and I think everyone should be at least interested in learning more about it, and you feel like your income will be too high, here's a couple of things you can do in order to still contribute to a Roth IRA. The first thing is called a backdoor Roth IRA conversion, and what that means is you would take the $6,000, you would put it in a traditional IRA, you don't get a deduction in the year, and then you convert it right away within like a day or two to a Roth. Now, if you earned some money in the account for the couple of days, you might owe a little bit of taxes. But it's something that if you're planning on doing, you want to have a plan. Tell whoever your financial advisor is, this is what you want to do, so they can flip it into the Roth right away. The other option that you have is to ask your employer, if you have a 401k plan, ask your employer if they offer a Roth piece. So let's talk about some of the pros and cons of the Roth IRA, because just like anything else, there's going to be pros and cons to everything, and it's up to you to make a decision on whether or not this makes sense for you. So some of the pros that you have is the obvious one, tax-free growth. You contribute, it stays in the account, it grows, you don't have to pay taxes on it. Okay, so another pro that you want to think about is after you've had the account open for 5 years, you are allowed to take the contribution piece out tax-free to use on anything you want. So whether that's, for higher education, to buy a house, to buy a car, something like that, you can do it. Ideally, it's nice to leave the full amount in and have it grow completely till retirement. But if that is something that you need to do, that is a good advantage. Finally, the last advantage is what I want to bring up is something called the required minimum distribution. If you have a 401k or a traditional IRA that's not a Roth, when you get to a certain age, they make you take a certain amount out called the required minimum distribution to make sure you're paying taxes on that. They want you to pay your taxes on it eventually, so at a certain age, they're going to make you take that out. For a Roth, you don't have to do that. So if you wanted to keep it in forever and you didn't need it, and you even wanted to have your next generation inherit it, you never have to pay taxes on that money. And it's an outstanding advantage to have. All right, so let's go over some of the disadvantages of a Roth IRA. And one of them is that you can only contribute $6,000. So it's a very limited amount. I wish you could contribute more. It would be nice to contribute more money to the account than available. Another disadvantage is that you cannot take a loan out of the account. So for a 401k, you can take an amount out sometimes. You take an amount out you need, you make an agreement, you sign it over with your employer, and then a piece of your paycheck gets paid back, and eventually you can pay back that 401k. For a Roth IRA, you can't do it. If you take it out, you take it out, and that's it. You can't put it back in. Another disadvantage would be that you don't get a tax deduction in the year in which you are contributing. So that's important because even though most people would find benefit in not having to pay taxes on all of that growth, if you are in a higher tax bracket than what you're going to be in your retirement, it may make sense in that year to do a traditional. If something were to happen and you're in the highest tax bracket, it might make sense to just take a year off from the Roth and do that. So just something I'm a CPA, but I'm not your CPA. So something to kind of look into and go over with your tax professional and make sure that you're taking advantage of everything. All right, so just like everything else, it's nice to be able to kind of see what could happen if you are in an ideal situation for the Roth. So this is a Roth IRA calculator, and it's based on certain assumptions that we're making. And so again, if you're someone who's at a young age and this is something that you have a job and you have earned income, you want to make sure that you're budgeting this and starting, because the earlier you start with compound interest, the more it will be accumulated by the time you retire. So in this scenario, we're starting with $1,000 balance. We're going to take advantage of the $6,000 maximum contribution you can do. Your current age is 22. You're going to retire when you're 65. We're assuming a 7% rate of return, and we're assuming we're in the 24% tax rate. So with all that being said, they're saying that for every year, if we accumulate all of the contributions we made in all the years that we worked, that would be $258,000. But when we retire at 65, it will be worth a little more than $1,600,000. So what they do here is kind of show you how your Roth IRA will grow as you contribute the $6,000, and that growth and compounding amount will get higher and higher versus a taxable savings account that you might have that has maybe a smaller interest rate. So what is the most amazing thing about this? If you start early and it grows and you get to a retirement age where it's you have $1,600,000 now in your retirement account, all of that growth between $258,000 and $1.6 million, you don't have to pay taxes for. You don't even have to take the money out of the account. So some people will just live modestly on this and be able to maybe only live on the growth piece every year. Like let's say you're guaranteed to have a 5% growth rate and you only take 5% out, you never really have to touch the principal. You never really have to pay taxes on it. And then if you're so inclined to want to, have that go to a next generation, that's available. Or if you want to take more out and do whatever you want with it in retirement, you can. So 3 things I want you to remember on this if you are interested in starting a Roth IRA. The first thing you want to think of is the earlier you start, the more your account will grow over time. 2 is when you're thinking about how much to contribute, try to do the maximum. But what's more important is to use a dollar amount that you can budget out, where if you're contributing on a recurring basis and that money's automatically going in, you're used to that money going in and you don't have to take it out. Because even though you can tax-free in certain situations later on in life, the more you keep in it, the more it will grow at the end. And the third thing I want you to think about is if it's something that in the past people have told you can't take advantage of because you make too much money, look into the other options I talked about earlier in the video, because there are ways that everyone can take advantage of this. It might take a couple of extra steps, but it's certainly worth it in my opinion. So what do you guys think? Did I convince you to open an account? Maybe you already have an account and you're going to contribute more. I hope you do. It's one of the most exciting things about retirement. When I see these numbers and how big they grow, it gets me more and more excited to keep making that recurring contribution that I've set up that never changes. And of course, if you like this video, please give it a like so that the algorithm can pick it up. We can see more people. And if you find you found value in this and someone else please share the video with them. Subscribe to the channel for more information on personal finance, different tax changes, and other topics that we're going to talk about on this channel. And I hope everyone has a really great day.